What's up, everybody? I didn't really tell anybody I was going live. I was going to post it on Instagram, but it's Monday and it got a little late on me, and I wanted to make sure I went live, even if it was just for 20 or 30 minutes tonight. I've been doing Monday nights, kind of like Money Mondays, I guess, if you will. But in all of the madness for GameStop fiasco, I haven't really made the time to talk about it very much. Not on Instagram, not here on YouTube. Hi, Estella. How are you? So I wanted to just talk about it and answer questions, see what you all are thinking about it, what you've been reading, what you've been watching and hearing about GameStop. Answer any questions, I guess, that I can answer from based off of what I do know. And yeah, and just general Q&A about investing, because last week I jumped on here to do a live, not on Monday. I did it on Tuesday. And a lot of the people that were in the chat box were like, can we talk about investing? Like, we have some questions about investing. So, and then this whole thing happened last week with GameStop. So it's kind of like the perfect time to talk about it. So if you guys have questions about investing, start dropping them in the chat box, especially if they relate to GameStop and everything that happened with all the Reddit mess and the hedge funds and everything that went on. I can definitely like explain like the general events. My lips are still dry. Sorry, guys. I need to put chapstick on. But I can definitely explain the general events. But I wanted to make sure I'm not repeating anything that people are pretty much familiar with. So, I'll see what questions come up first. What's up, Juicebox? Jonathan Ramos, welcome. Roll. I don't know all those numbers after your 112 358. I don't understand what shorting stock means. Okay, I can do that. I can talk about shorting stock. So, okay, I guess I can essentially just go over what happened pretty much and then talk about shorting in there. So pretty much the company GameStop, if you guys don't know about it already, it's an electronics store that sells video games, electronics, collectibles, things like that. And you could go into the store and trade in old games and use that credit to buy new games. And then you could also go there and buy like game consoles, Xbox, PS5, that type of stuff. So it's kind of like getting a little bit outdated, I guess, at this point, because most people have transitioned over to online gaming and e-gaming. And so people have already been like buzzing and wondering for like a few years already about how long is GameStop really going to continue to be a functioning company and be afloat. Because if people are already gaming online and there's so much stuff digitally, like nobody's going to go to a physical store just to buy games. They can buy games online. So the company had already been struggling. They were not making a lot of profits. They weren't very profitable. And the prediction that they put out saying they were not going to be profitable was until 2023. And that's if things went well and they were able to make a shift to the digital world, which there were no announcements about them doing that. And so pretty much there was concern about that company and the success. And so some Wall Street hedge fund managers, which if you don't know what a hedge fund is, it is basically a group of investors. Only high net worth individuals are really able to afford to or even allowed to invest in hedge funds, because we're talking about lots and lots and lots of money, multiple millions and billions of dollars being invested. And the hedge fund manager is the person who is going to make decisions for that investment fund. And they are very open and clear with the investors that they're willing to do whatever it takes to get profits. They can do very risky investments. They can do things that are probably not typical. Like you would not see mutual fund managers or, index fund managers. Well, index funds don't have managers because they're passive investments, but mutual fund managers or exchange traded funds that are actively managed wouldn't really be taking the crazy levels of risk that you might see in a typical hedge fund. So basically, it's a group of very rich people who want to get even more rich. And so the manager is willing to take risky bets and do kinds of things that will lead to more money potentially. But obviously, they take a lot of risk with that as well. Now, at that point, those investors can afford to lose a lot of money because they got millions, billions of dollars. Like it'd be a big deal if they lose 5 million, if they lose 10 million, they have so much more money. They're very extremely wealthy. So those are the types of clients. And then also a lot of institutional investing as well happens with hedge funds. So like 401k plans or pension plans, which are, obviously giant funds that, pool together the money from people's retirement accounts, which is kind of sad to think that like if a hedge fund loses money, the people that actually lose are the people who were investing in their pension or 401k. But, that's the way it works. So pretty much at that point, what happened was everybody knew GameStop wasn't really doing so well. And, they weren't profitable. We already talked about how they're not competing in the e-gaming world. So Wall Street hedge fund managers were like, yeah, there's not really any hope for GameStop. Let's be real. They look like they're going downhill. So when something is looking like it's not doing well, you can actually benefit from that if you bet against the company. So like everybody knows, you can buy a share of stock, and if it goes up, yeah, you make money. If it goes down, oh, you lose money. But there's also this concept called shorting, which is where you bet against the company's success. You say, I bet you that company is going to drop. I bet you the price of a share of stock in that company is going to drop. And if you're right and it does drop, you can make a lot of money because you bet correctly. So how in the world does that work? Well, basically, I was actually talking to a reporter today who was working on an article about teenagers and what lessons we could teach teenagers at home, parents and teachers about investing. And the example that I gave the reporter was that imagine that your friend has a pair of Jordans and you borrow their Jordans, and they're not like brand new Jordans that just came out. They're Jordans from like maybe a couple years ago or whatever. But you're thinking to yourself, like, I'm going to borrow the Jordans because my friend never wore them. They're still in the box, wrapped in paper, like nobody touched them, nobody wore them. So I'm going to borrow them from my friend and I'm going to sell them. I think right now they're probably worth about, $100, $200. I'm going to sell them for $200 because I think next week they're going to drop to like half off because nobody is really talking about these Jordans, and another pair of Jordans is coming out next week anyway. Whatever the reason is, you have a feeling that those Jordans are going to be less valuable next week. So you borrow your friend's Jordans that are fresh in the box, ready to, you sell them on eBay, on Facebook Marketplace, wherever. And you get, let's say $200 for that pair of Jordans. Now, they're not yours. You borrowed it from your friend and sold it. So now you still owe your friend back $200 for those Jordans. Like, hello, your friend needs their shoes back. But next week you go and you're like looking at prices of Jordans and you think the price is going to drop. So if the price does drop and the Jordans are on sale for, let's say, $40, $50, you go online and you buy them for $50. Now, remember, you sold them for $200. And so now if you buy them for $50 when they're on sale, you give back your friend, you give the Jordans back to your friend, and you basically profit $150. So that's the idea of shorting. It's you're borrowing stock in a company, you're going to sell it for the value that it currently has. And then next week, 2 weeks, whenever, you're betting that in the future, the price is going to drop. And when it does drop, you're going to buy it back at that lower price and give it back to the brokerage firm. And you're going to keep the profit. So you make a lot of money that way. And so, but the risk is that what if you sell the Jordans and then next week, when you go to check and see if the price dropped, all of a sudden, everybody's talking about these Jordans and now they're considered vintage Jordans. Now you got to pay $900 if you want to cop a pair of those Jordans. So now you're freaking out. You're sweating. You're getting nervous because you literally sold them for $200 and you thought you were going to make money. And now you better come up with $700 from somewhere because you only made $200 off of them. And now you need to buy them back for $900 because you need to return them. So that's essentially what happened. Wall Street hedge fund managers were betting that GameStop's stock was going to drop. And instead, like 2 million people in a Reddit group were watching these conversations for months and months and months about how, Wall Street hedge fund managers were betting against GameStop. And so in the Reddit group, which is called Wall Street Bets, they were planning and plotting like, hey, if we all buy GameStop at the same time, they're betting against it, but we are going to make the price go up because when everybody's buying it, the value of it goes up because there's more demand. So that's pretty much what happened inside of the Reddit community. In that Reddit group, they have been talking about it forever and they all joined forces. Like it's kind of like a miracle. Like I have never even heard of millions of people. There were 2 million people, but I don't think it was 2 million people buying, but like millions of people all at the same time, hundreds and hundreds and hundreds and hundreds of people agreeing at the same time to buy stock so that the price goes up because there's a lot of demand for it at the same time. So once that happened, the hedge fund managers were freaking out. And the only way they could fix their problem is to either hold on to, wait, just don't purchase it, because right now, if they were to buy it and the price is really high, obviously they're going to lose a lot of money. So they could either wait and just don't do anything until, if they really believe the price is eventually going to drop back down, then they can buy it. So they could do that. Or they can buy it right now at the higher price, take the losses, and return it to the brokerage firm. So what's the difference? Well, the difference is money. They have to pay the longer they wait. It's just like a credit card. Like the longer it takes you to pay, the more interest you're going to pay on that credit card until you make your payment. So it's better for you to pay it off faster. So for them, they borrow those stocks from GameStop. They have to return it ASAP. The faster they return it, the less they're wasting, because they have to keep on paying interest fees, pretty much to hold on to it. So their goal is to try to return that ASAP, to stop paying all those fees. And on top of that, they keep seeing it going higher and higher and higher. So they're just trying to all right, cut this out. Let's just buy it back and let's just give it back. And so in order to do that, they obviously need to buy it back. And now they're buying it at a much higher price, which means that they are also adding to the demand for that stock, which adds to the stock's increase in price. That's why the price went up like crazy. Within 2 or 3 days, it went from $40 to over 400. So 10 times the growth, which is insane. All right, so so that's pretty much what happened. And then there's a whole Robinhood drama that happened where a lot of the traders were using Robinhood to buy, shares of GameStop. And when they try to go back on after a couple of days to keep buying more, at one point, Robinhood literally said, you cannot buy any more GameStop stock. You can only sell. And as you know, the way supply and demand works, there's a balance between supply and demand. So Robinhood, what they did was they cut off the demand and only allowed for a supply, which means that they made an imbalance. They cut the balance of the supply and demand of the stock market, which is messing with the market. That's market manipulation. And so that's when the media just went crazy. Forget about it. This has never happened. This has never happened where a company literally just prevents, or a brokerage firm literally prevents you from buying shares of a stock just because of high demand. Usually it's if there's crazy volatility, if it goes up too fast or too, they might pause for a little bit and then let people trade again, but they wouldn't let you sell but not buy. This was super weird. It was the first time in stock market history that something like this happens. That's why it made the news. That's why it's kind of crazy and it's everywhere. Okay, so let's see what questions. So I already talked about shorting and what shorting means. Hopefully you guys have a better understanding of shorting. You borrowed it, it's not yours. You sold it at a high price and you're hoping to buy it back at a cheaper price so you could keep the profit. Alexandra, I talked about what a hedge fund is, but it's basically an investment fund. So when we invest, average everyday people that have average amounts of money, we're called retail investors. When we invest in investment funds, usually it's a mutual fund or an exchange traded fund or an index fund. Hedge funds are for people that have an extremely high amount of wealth, and they are willing and able to take extremely high levels of risk in order to try to get that potential to get a higher return. So they're doing crazy things like shorting stocks and, doing all kinds of options and doing crazy types of investments that are considered to be very speculative, which means that they're very high risk. At any point, they could just lose all that money, but they're willing to try to make more, and they're willing to lose it because they have so much. It's not a big deal. Somebody like me, I would never be able to take that much risk because I can't afford to lose all of my money. So if I had a giant pile of money and I could just afford, millions and billions of dollars, sure, I might take more risk, because if I lose the money, big deal. I got a giant pile of money over here that I can, fall back on. So it's definitely not for average people. Hedge funds are investment funds that take extremely high risk in order to chase after potentially very high rewards. And it's only for people with a whole lot of money, like super uber high net worth people. Yeah, it's definitely fascinating to watch. It's first time in history, so I think people are definitely going crazy. Now it's being called meme stocks or meme stonks, where it's basically the virality of it. Like everybody's talking about it, and now it's going up because more people are buying it. So first they were saying, oh, that's what happened with GameStop. Then it happened with AMC, and then now people are saying, oh, silver. this is what, like, now basically taking investments and turning them into memes, like basically where everybody has seen it. Like if I put a picture of the Michael Jordan crying, everybody would be like, oh yeah, I've seen that, right? Because it's a meme. It's so viral that everybody recognizes it. That's essentially what these meme stocks are being called. Like if everybody and their mama has heard about it, then it's a meme stock. If you're starting out with investing in stocks and options, I found Robinhood the easiest to navigate. It is definitely the easiest to navigate, but that's for a reason. The more trading that happens, the more money Robinhood makes, because Robinhood feeds your trades and your requests for options and trades. They feed that to Citadel. Citadel is actually where the trades occur. Robinhood is literally just collecting the requests for trade and passing it on to Citadel. Now, the other ways that Robinhood makes money is they get paid when they feed data about you and the trades that you're making to hedge funds. Hedge funds like that data because then they can look at it and be like, oh, if this is what all the traders are doing, then we can make decisions either that we want to align with that or we want to bet against this, right? So they're basically helping hedge funds make so much more money by making informed decisions about what they want to do by looking at data from 18 million Robinhood users. So, I never opened a Robinhood account. I have never been a fan of Robinhood. I've had people from Robinhood reach out to me and ask me to sponsor posts and stuff. And I'm like, no, thank you. Not interested. Because what they're doing, if you guys have ever seen The Social Dilemma, they're turning investing and trading into a game. They're gamifying it like if it's an app that you could just play. Like this is not Pac-Man, bro. This is people's lives. This is people's livelihood. When you think about how much people are trying to make from investing, usually it's big amounts of money over long periods of time. People invest for retirement. People invest to buy a house. People invest to put their kids in college. People invest to create businesses. And now it's just becoming so trendy, like that people are confusing investing and trading or investing and speculating, but they're not the same thing. They're very different. Investing is a long-term thing. You use strategies that are, tried and true, that are going to lead to lots of money in the future. Historical data shows that it's, the number one generator of wealth is long-term investing in the stock market. But now it's like people think trading stocks is investing. And that's the dangerous part. I think that came from Robinhood because they're the ones that made it 0% commissions. They made it free for people to trade. Interesting, because if everything is free for you, then you know what that means. You the product. It's just like Instagram. Instagram is free, right? But why? Because you're the product. We're the ones that are seeing ads like crazy. We're the ones that our data is being shared with companies, with advertisers, with marketing agencies. But we're the one where's the commodity. So that's basically what Robinhood did. And I'm not a big fan of it because there's a lot of young kids that don't know what they're doing. A lot of my younger family members included, and some of the kids in my own community, I'm seeing them download Robinhood and get involved in options. Like options allows you to basically purchase the option, the opportunity to buy something at a higher or a lower price later in the future. But the thing is, if you bet against something, you have to remember you're betting against it. And if it doesn't work out your way, the price can keep going up. You thought the price was going to go down, but what if the price goes up and keeps going up? There is no limit to how high a stock price can go. It is unlimited, like infinity, because numbers go up to infinity. So the price could keep going up and up and up and up. In theory, theoretically, it could keep going up to infinity. And you're betting against that. So what does that mean? That means that the money that you lose is basically infinite. You could have infinite losses because the company could just keep going up and you see it and you're freaking out because you're losing. You could have infinite losses. That is extremely dangerous. And so for me, it's kind of like, do you really think an 18-year-old should be able to get their phone, download an app, and start investing in options without knowing nothing about it? That's extremely dangerous. And in case if you guys didn't know, you should definitely Google it. There was a whole article about a little boy, well, not a little boy, he was a young man, a young man who committed suicide because he saw how much money he lost from risky bets on Robinhood. And he left a note saying, think I didn't mean to take that much risk. That's not what I intended to do. And it didn't work out. And he was in so much debt. He lost so much money. He had a negative balance in his account that he owed money. And he was so just so nervous about how is he going to come up with hundreds of thousands of dollars? So he committed suicide. This is the type of stuff that come on. If your platform has created a space where that would occur, I'm sorry, but I cannot support that. The only good thing that I think came from Robinhood is that 0% commission. So all the other competitors, Fidelity, Vanguard, E-Trade, Schwab, all of them, when they saw that Robinhood was making 0% commission, they were like, okay, well, we got to keep up with the competition. So they all dropped their commissions to 0% as well. So now trading is virtually free, which is great. That's a great improvement in the industry, because why do they need to pocket commissions anyway? They're just literally making profits off of people investing and or trading, and they don't need to. They get paid in other ways. So I get it that they did a positive thing, but I think overall it does more bad than good. And especially given the fact that they claim that they are democratizing finance for everybody, really, then why did you not allow people to buy more GameStop when they were making a lot of money off of it? Oh, because it was hurting the hedge funds. Oh, because it was hurting the exact hedge funds that pay you for data. Interesting. So your number one customer, one of your top customers that pays you to give them data was hurting. And so you did what you had to do to protect the people that you're really invested in, not the customers, not the traders, the hedge funds. So to me, I just was very disappointed. Reading this, I was so frustrated because I can't even believe they did that. They shouldn't even be allowed. If you don't have enough money to allow people to keep buying and trading and selling and everything, you don't get to just take the imbalance off of the supply and demand. If you don't have enough money, you need to cut both. Say, you know what? Because of limited availability of of flow, they probably didn't want to admit that they didn't have enough money to give people that are trying to pay to get a cash out. If they're trying to say, oh, I have this many stocks of GameStop here, I want to cash out. They don't have the cash to give them, right? If that's the case, fine. But at that point, they needed to cut all buying and all selling. They needed to say there is no longer any buying or selling of GameStop. And that's my opinion. That would have been the fair and the right thing to do. Too much volatility. We can't handle this. We're just not allowing GameStop specifically on our platform until we sort this out. No, they left the selling. You could still sell, which means that the price can go lower. If everybody is only selling because that's the only option you have, what happens to the price? It goes down. And who does that benefit? The hedge funds who've been waiting for the price to go down because they've been, nervous about it going up the whole time because they bet it was going to go down. So it's a very interesting thing. It has a lot of emotions involved. Young traders getting excited, everybody downloading the app, everybody wanting to buy a GameStop because of FOMO. And then on top of that, there's this clash of classes, average, everyday, hardworking people, normal investors, average income earning people, retail investors versus Wall Street. It's kind of stick it to the man. There's all of these emotions involved. There's so much psychology to it that's just a recipe for disaster. It's clearly very dangerous to get involved in that. So if anybody put in the chat questions about, did I get involved? I think the answer is pretty obvious. You could probably tell by what I'm saying. No, I do not own any. I own the total stock market index fund through Vanguard total stock market index fund. So yes, I have GameStop in there because I own I own shares of every stock in the United States. But I did not purchase individual stocks in GameStop when this all happened. And I wouldn't, even if I could go back in time, knowing what I know now, I wouldn't, because I personally would not stomach the risk of losing my money. I don't want to. I want to make sure that I'm being smart about my money, and I'm not here to play games. So that's me, right? That's my personal opinion. All right, let's see what you guys are saying out here. Good job breaking it down. Thank you. Should I stay in Robinhood? Well, that's a tough decision, Leslie. There's a lot of people that are deciding to leave. But what you need to know, if you leave, you have to pay a $75 to transfer your money out of Robinhood into a different brokerage. So basically ask yourself this, based on everything going on, all of the scandal around it, if you really want to be loyal to them, stay. But if you want to leave, you need to bite that bullet and just pay that $75. And at the end of the day, they can change it. They can make that price higher. If they notice a lot of people are leaving, what's stopping them from saying, oh, you have to pay $150, or you have to pay $200 to transfer? They make the rules. It's their platform. So right now that it's $75 and a lot of people are leaving, like that's a big thing for decisions. I know a lot of young people are like, man, I wanted to leave, but it sucks that they're charging that high of a fee to move my money out and close the account. So hopefully, if you didn't know that, hopefully now you know, and you can make the decision. Yeah, a lot of people are saying just keep holding, just keep holding, just keep holding. And today, what day is it today? February 1st, Monday, when the market closed at 4 p.m., GameStop stock was down negative 30%. It was it was under $300. And that's to be expected. It was up, 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 up. They prevented people from buying it. The next day, when it opened again in the morning, it was up, 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 up. So, there's only so much up until what comes next, down, right? Hello, it's what goes up must come down. So I think it's just hard to tell. Is it going to keep going up and down, up and down? Is it going to keep going up? Is it just going to go down every day? Like, that's the thing about playing with the stock market. Like, if you're going to be trading like that, you have to have a stomach for that. You have to be okay with like that constant not knowing, and you could be wrong. And that's not for me. I'm gonna tell y'all right now, I got too much going on. I got a family, I got a boyfriend, I got an apartment, I got a job, I got a side hustle, I got emails to send, I got a niece to babysit. I got look, how am I gonna find time to be keeping track of this trading, constantly obsessing, looking at it on my phone? I have a life. Like, every month, the same amount of money gets taken out of my account, of my checking account, and gets deposited into my investments. And it just keeps on investing, keep on buying more shares, ETFs, index funds. Okay. And I know that it is going to keep growing over time because I'm betting on the American economy. I'm betting on the United States. And 8 times out of 10, the economy is up. So to me, it's not worth it personally to be constantly stressing about trading and trying to make quick bucks here, quick buck there, trying to make fast money. Like, look, stop it. I don't have time for that. Who wears Jordans? Didn't he retire a long time ago? What, Javier? Have you not been to any hood in America? Like, everybody wears Jordans. I mean, maybe I'm assuming that, but where I grew up, everybody wears Jordans. And when I was growing up, it was a huge thing. Oh my goodness. I need to scroll down. Y'all have so many questions, and I have been in the top section, only looking at the first few comments. Let's see. Yep, clearinghouses had to catch up. That definitely is. Listen, there's a lot of people talking about the clearinghouses. At the end of the day, again, like I said, they should. If that was the issue, then cut everything. Don't just cut one side. You have to cut both sides if you're going to be fair and if you're playing honest. A lot of you guys are talking about holding. Look, y'all can have that conversation without me because I'm not invested in that. Oh my God, this is too funny. Rob said, I'm telling my kids GameStop and AMC were Silicon Valley. I'm dead. I also saw another meme that said, it was like a little girl on her dad's lap, and she was like, Daddy, what did you do back in the day during the coronavirus pandemic? And the dad was like, I saved GameStop by crashing the entire stock market and making billionaires lose millions of dollars. Like, it's like, really? This is what you think? You think you're a legend? I mean, I guess it is kind of legendary. Let me stop hating. The squeeze hasn't squoze. I'm done with all these diamond hands. No, God, stop. Yeah, a lot of people do think it was illegal. There is a class action lawsuit right now where some investors are saying that because of their actions, they were not able to invest and grow money the way they would have been able to if they were able to buy. So we'll see what happens with the lawsuit. It is absolutely illegal. And, I guess it's not absolutely illegal. It's absolutely unclear as to whether that's going to be considered illegal or legal and how that case is going to go. But definitely a lot of interest in that. Let's see. There are so many questions. Oh my God, I'm just trying to literally read and keep up with them. And also a lot of comments here. Put the link to the Reddit forum. Really? I mean, sure, share that if you guys want to look. There's so much random stuff in there. It's definitely a subculture that is an interesting group. They have so many inside jokes. I just scrolled through just to see some of the memes and comments, and I was like, I cannot keep up. How were they able to do that in secret without people finding out they were going to do it? Well, it's just a matter of like nobody was paying attention to that Reddit group. Just the people in the Reddit group knew because they were in it. But until it actually started happening and then it started spreading and then it happened more, that's when people realized, oh, it started with the Reddit group and then it spread. So, honestly, it's just like anything. It's just like having a Facebook group with like 1 million people and then they decide something. Like that's just 1 million people. Like there's so many multiple millions of people for 1 million or 2 million people to be in a group. I mean, the whole world's not going to find out until it gets exposed. And oh, that was a good question. Somebody said, how did they even know that the hedge fund shorted GameStop? So that's public information. Like I think it used to be quarterly, and then it changed. I don't remember when, but I read about this, but it changed that from quarterly reports, they had to now do it monthly. So now every month the hedge funds have to put out, their records showing it's public information. So if you're looking at their records and you're looking at what they're doing, you see what they're shorting, and it's public information for people to know what they're doing. All right, looks like a lot of now general investment questions are coming in. So I'll just transition over to investing generally. And if I see some other questions about GameStop stuff that I can answer, I'll try. I think I'll probably be on here for like another 15, 20 minutes though. Okay, so I have a 401k question. Our office invests and it matches 3%. It's doing really well on projected based on our retirement age, but I think it's scary. I don't know where it's invested. It's confusing. Okay, so that's a great question. That's how that be saves. You can find out if you just go onto your 401k plan, find your online portal, use your username and password, log in. You can look at every single one of the holdings in the funds that are in your 401k. And for example, with my 401k, I had a couple options, and my old 403b, when I was a teacher, I have very limited options. It was only target date funds from Vanguard, that's a good option. If you only have that option, great, don't complain. But I didn't really know what that was. And I remember I just randomly picked one because I copied off of another teacher that worked at my school because I didn't know what I was doing when I was filling out the paperwork. But now looking back, I'm like, oh, wow, that was actually a really solid way to start. If you don't know anything and you just pick a Vanguard target date fund that was the year that you want to retire, that's great. Like that's a good start. And so what you can do is just look at the funds that are in that 401k plan based on your selections, and just make sure you look at the holdings that are within each fund. So you might have multiple mutual funds. You might have some stock funds, some bond funds. You might have balanced funds, which is both stocks and bonds inside of the same fund. Most 401k plans have mutual funds inside of them. So your job is to find out what are the holdings of those mutual funds. And then you won't necessarily be in the, in the dark anymore about it. What are my favorite ETFs? Right, I don't have favorites. I default everything. Right now, the ETFs that I'm in is, y'all know what I'm about to say, total stock market and S&P 500. Look, I'm an index girl all day. I think the ticker symbols are VOO and VTI. Those are the ones that I personally invest in. That is not investment advice. I am not an investment advisor. I'm just sharing my personal business out there in the streets in case you're curious about what I do. But yeah, I'm definitely big on just catch everything in the market. The whole S&P 500 is a really good proxy for every company in the US. It doesn't include them all, but it's a very good proxy. And total stock market, hey, you have them all. You have the good, you have the bad, you have the winners, you have the losers. And so you're just going to get the average over time. If you look up the statistics over the past 20, 30, 40 years, the average return of the S&P 500 has been very good. I'm talking about 10%, 11, 12%, 9%. Those are great returns to compound over 30, 40 year career. Like you're going to be doing all right if you keep putting money in from every paycheck over your working career. The thing is that people are impatient nowadays. We don't want to wait. We want the money now. We want to try to, take that risk and see if we can make the money faster. And it's like, oof, okay. You already know the story of the tortoise and the hare. Slow and steady wins the race. Let's see. They're Robin the Hood. That's why they're called Robin Hood. I'm done with these jokes. Let's see. Other questions about investing that I can answer. Any changes that we should make based on this? If you're a long-term investor, you have your long-term strategy. What are you changing? What are you changing? There is nothing to change. I have not touched my investments. I do not plan to touch them. I have a long-term investment strategy in place. That's that. Aside from my retirement, I have general taxable investment accounts. Every single month, I automate them. So just money gets taken out of my checking account, goes right into my ETFs in my general taxable investment account. And the reason why I have ETFs outside of my retirement account instead of index funds or mutual funds is because ETFs, exchange traded funds, are better when it comes to tax advantages. So if your investments inside of a retirement account, like a Roth IRA, a traditional IRA, or 401k or 403b, any other types of investment accounts that are specifically for retirement, most of those are tax benefited. Retirement accounts are tax benefited accounts. They're tax advantaged. So that means that whatever taxes you normally would have to pay at the end of the year when you file your taxes, you don't have to pay until retirement. It basically delays all of the taxes. So what you want to do outside of retirement accounts, you want to be smart and try to research what are some ways to make sure that I'm not creating a lot of taxable events for myself, so that when I go to pay taxes in April, like I'm not going to get smacked with crazy taxes. Because that's another thing. A lot of active traders, especially these young kids now going on to Robinhood, be like, oh, I made $3,000. I made $10,000 from GameStop. I'm like, okay, did you actually factor in the taxes that you're going to pay for that? Because you're not keeping all of that. And if you think you're keeping all of that, you're going to have an ugly surprise in April when the IRS comes knocking on your door asking you for money. So you need to make sure that you're aware that every time you're investing, there are tax implications. And that's why it's so important to get financial education, to be reading, to be learning. That's why I talk about this stuff, because a lot of young kids, they don't even have a clue about the tax implications of what they did, and then they sell, they cash out. They think they made the money, so they go shopping, buying all this stuff. And then when time comes to pay the taxes, they don't have the money anymore. They're like, what do you mean I got to pay taxes? I don't have the money. I spent it. So you better be prepared. If you're constantly trading and cashing out money, you better be prepared to set aside a chunk of that in an account that you don't touch it for, specifically for when you have to pay taxes on that money. That's why you set price limits. And so, yep, there's a lot. Listen, there's a lot of types of trade orders, market orders that you can make. I'm not, listen, I'm just not a fan of active trading because it takes time. I don't got that interest. I don't have the interest. Let me be real. I don't have the interest. If I want to gamble, I'll take some play money, go to Atlantic City with my boyfriend, have some fun. If I lose the money, I lose the money. It's fine. I went there with that as play money, right? I just don't think that that's how I want to approach the stock market. That's just me. Yes, I am on Clubhouse. Dalia Lafleur, I am on Clubhouse. I was actually just on it last night having a conversation about debt repayment with snowballwealth.com. They had me on as a speaker, and every Sunday at 5 p.m. Pacific, 8 p.m. Eastern, they have on Clubhouse paying off student loans and other types of debt conversations, and they're so great. They're like hundreds of people in there. You could go in, ask to go on stage, ask your question. So definitely check those out. I'll probably speak at a couple other ones in the future too on Sunday nights. We'll see. This replaced the gambling addiction for a lot of people. That's true. Emily Morales, that's a great point. A lot of people stuck in the house, they usually go out, they usually go gamble at the casinos, they usually, play the lotto, they usually do all these things. But now we in the house, that's another, I think, emotional and psychological piece of it. A lot of those people, they got to get their gambling fixed. It's just really unfortunate because you start off thinking, oh, it's just for fun. And then you end up addicted. Gambling is literally like a drug. Like it can lead you to become addicted and you never admit you're addicted. It's like, oh no, I'm good. I can stop anytime I want. Then why haven't you stopped? Like addiction, like it's serious. It rewires your brain and you need that fix. And it's dangerous. I wouldn't mess with it personally because I don't want to get caught up in it like that. I don't want that to happen to me. Let's see. People generally just don't understand the consequences. Ooh, Joseph Bowie, that's a great point. A lot of people don't. They definitely don't. I like trading baseball cards. Oh, man. Okay, that's definitely safer than trading stocks. Great call on the Vanguard funds. Thanks, Mike Falls. I mean, honestly, what I do a lot of reading, and over time I've read a lot of books, and I just find that, like, listen, if you are an average person making average amounts of money, just listen. all you want to do is make sure you retire with dignity. And I mean, unless you're really chasing after a lavish lifestyle while you're young, like if that's what you're trying to do, fine. I just, I can't relate, but I just feel like I'm just trying to be comfortable. I'm trying to be happy. I want to be able to give to my family. I want to be able to support myself and have a decent, lifestyle. And for me, I can do all of that with, multiple streams of income, an average salary job, or hopefully slightly higher than average income if you work really hard and, work at your craft and work your way in your company, whatever, work and dedicate yourself to what you work in, you can move up and hopefully make more than average salary. And if you're just putting a little bit away every month from what you earn, you definitely can retire with dignity. I think back to my parents, they never had an opportunity to invest in a 401k. They never had that opportunity. So of course, me being in the next generation and getting an opportunity to sign up for a 401k, of course I'm gonna sign up for that 401k. Of course I'm gonna put as much in as I can put in to get the match. Of course I'm gonna open a Roth IRA. Of course I'm gonna have a brokerage account and put even more money if I can afford to after all of that, because I have to start building wealth because my parents didn't have the opportunity to do that. Yeah, Mike, great point. Vanguard has like some of the lowest transaction fees for sure. They created the idea of the index fund. Jack Bogle did. He created Vanguard, and he died recently, a couple years ago. And he could have died a bajillionaire, and instead he was just a multimillionaire, because instead of taking the money and making the company his, he made it a nonprofit, which meant that it's member based. So a lot of times when the profits come in, instead of just going to the leaders, it would get spread out and go back to the investors. And these are common people, everyday, working Americans. So I gotta say, I really like Vanguard for that. I like what it's all about. What about just selling Robinhood positions and sending the money back to my bank account? Yep, you still gotta pay $75. If you want to take the money out of Robinhood, you gotta pay $75. Don't be a bag holder. Yeah, y'all are funny with these slogans. I can't. An algorithm brought me here. Welcome, welcome. And I'm glad the algorithm worked for you and not against you. You can call the broker and ask them to pay the 70. Yes, great point. Who's that? Alshur Fi. You can call your broker that you're moving the money into and ask them kindly if they will offer you the courtesy to pay that $75 fee to Robinhood so that you don't have to. And then they'll probably want to do it because they want you as a client. So worst thing that can happen is they say, no, sorry, we had too many people ask us. We can't do that. Great. Okay, well, it's worth a try. Let's see. Any other questions from y'all about investing? Valeria says, my boyfriend and I want to get a home as the next step, but he has bad credit and I have very new credit, just 2 months old. Will it be impossible to do this in the next 2 years? No, Valeria, you can actually significantly repair and fix credit in a year, or even under 2 years for sure. I think the biggest things to focus on is debt to income ratio. When it comes to home ownership, you have to have a low debt compared to your income. If your debt and your income are the same, yikes. If your debt is higher than your income, yikes, right? They are looking at it as like, hey, your money that your income is coming in, you're either going to put it to the house to pay the mortgage, or you're going to put it towards your other debt. So they don't like to compete with you for another type of debt. So you want to have a healthy debt to income ratio. So just focus on that. If you and your boyfriend can pay down as much debt as you can in the next 2 years, and also just like, those other factors of your credit that really matter, not applying for credit in the next 2 years at all, just keeping the credit that you have, seeing if you can increase the available credit on any credit cards that you guys have rather than applying to new ones, because new ones will create hard inquiries and you don't want hard inquiries. Those are the types of things I would say to focus on. Let's see. Other questions? Oh, y'all are talking about like which investment platforms you like, if you like Fidelity, Acorn, some people mentioned Sachet. Listen, honestly, at the end of the day, you want to find something that's not killing you with fees. The fees is probably one of the most important decisions that you have to make, because statistics show over time, if you look at historical data, that fees is the number one reason why people don't get the returns that the average of the stock market gets. So of course, there's like all these studies that show that active managers, they don't get the return of the stock market, the average return of what the stock market gets, because they charge fees, they charge taxes. After, obviously they don't charge the taxes, but after you pay them their fee and then you pay your taxes, you end up with less than if you had just went with a super low cost index that tracked the entire stock market. So that's just data. That's just like hard facts right there. So at the end of the day, it's, it's just people trying to beat the average of the stock market instead of saying, you know what, I'm okay with 10%. Like, that's pretty good. No, I want to try to I want more. I want 18, I want 20, I want 40%. Like, okay, well, you know what happens when you get greedy. So it's important to find that right mix, and especially the right risk tolerance. Gabriela Gordillo, can you explain the difference between Roth versus traditional IRA? Absolutely. So whenever you hear the word Roth, just make sure that you think in your head that you are getting the taxes out of the way now so that you don't have to pay taxes again ever in the future. So for example, if you have a Roth IRA, that money that you put into the Roth IRA is money after your paycheck was already taxed. If you look at your pay stubs, you could see the taxes they took out. Social Security, Medicare, you can see the taxes that were taken out, state taxes, etc. And so basically, after the tax was taken out of your check, you're going to take a little bit of the money that you earned and put it into your Roth IRA. Now, since you already paid taxes from that income that you earned and then put the money in, you can't be taxed again. You only get taxed once. And so you let that money grow and grow and grow in the Roth IRA. And then when you go to take it out at retirement to pay for whatever, your lifestyle, traveling, your home, whatever, you won't have to pay taxes because you already paid it when you put the money in. Versus traditional IRA, you did not pay the taxes because, yes, you took money from your paycheck after it was taxed and put it into the investment account. So it sounds the same so far. But when you file your taxes, you get a deduction for any money that you put into a traditional IRA, which means that it's basically as if you did not pay taxes on it because it's going to be removed from the amount of money that you will owe taxes on. So whatever amount you put in the traditional IRA, they're going to subtract that and deduct it so that you are not paying taxes on it, and you get a tax break when you file your income taxes when you file your taxes for the year that you put money into a traditional IRA. Now, when you go to retire and you take the money out to pay for your mortgage, to travel, you're gonna have to pay taxes on it because you got that tax break. It was deducted. You didn't pay taxes on it before. So now in retirement, you're gonna have to pay the taxes. So you basically, when you're deciding between them, you wanna ask yourself, would I wanna pay the taxes now at the tax rate that I'm currently being taxed? Or do I think it would be better for me to pay the taxes at the tax rate that I will be taxed at retirement? That's the big question. So it depends. Your decision is going to depend on what you believe about taxes. Do you believe that taxes are going to be higher for you when you retire or lower for you when you retire? And then you just want to choose whichever one you believe is a lower tax rate, right? Everybody's always trying to minimize their tax burden. So whatever you think is going to be better for you, that you'll end up paying less taxes, that's the account that you would choose. And then, of course, there's like income limits and stuff. So you have to make sure you qualify based on your income. If you make over a certain amount of money, you're not going to qualify for the Roth IRA. So you have no choice but to put it in the traditional IRA anyway. Love it. These questions are really good. Okay, I'll probably do like another one, maybe one or two, and then I got to run. You're welcome, Gabriela. I'm glad you asked that question because I know a lot of people probably had same question. Oh, Louis Chen, you came late. Sorry, bruh. If you watch the replay of this, the whole first part, I was just talking about GameStop. So you just missed it. But now I'm doing just like general investing Q&A. But we talked a lot about GameStop, what exactly happened, and a bunch of opinions about it are in the chat. If you want to scroll up and down and read the hot takes, you can definitely do that. Jacob Andrews, how much can I contribute towards my Roth 401 per year? Also, can I contribute towards a Roth IRA in addition? Yes, you can put money into a Roth IRA even if you have a 401k at your job. For your 401k, you can put $19,500. For the Roth IRA, it's $6,000. So a lot of financial experts, they recommend first putting whatever you can put in to get the match from your company in the 401k first. And then once you get enough just to get the match, stop there and go and try to hit the $6,000 on the Roth IRA. And then when you're done, if you want to continue, if you still have money to continue, then you can go back to the 401k, or you can open up a general brokerage investment account, whatever. But the order would be like, try to get that match from the 401k, try to max out the Roth IRA, and then, and HSA, if you have a health savings account as an option, a lot of people recommend that as well too, because you can basically never pay taxes on medical expenses if you use the money in a health savings account. So if you're paying for things that are medical expensive, which, let's be real, as you get older and older, you have more medical expenses. So it's nice if you could just use money that you never have to pay taxes on it you save on taxes. Anytime you can save on taxes, people, I don't think people understand how much taxes take away from their income. Like I don't know if people really understand it. Like anytime you see tax advantage, like that's a big deal for a reason. The number one expense in people's lives is taxes first, and then rent, and then food and transportation. Like first it's taxes. We just don't consider that spending. We don't consider that us spending money, but it is. We have to, it's basically stuff that we have to spend. Let's see. Do you have any thoughts on Fidelity Zero funds? Yep. So essentially what Fidelity did was they said, we will have index funds that have 0% expense ratios. And they were the first to do that. So just like Robinhood was the first to say zero commissions on trades. When you trade stocks and buy and sell them, you don't pay any commission. Fidelity was the first to say you can invest in an index fund and pay 0% management fee. You don't have to pay them to manage it. So basically they're working for you for free. They're putting your money in an investment account, investing it in the stocks, and they're not charging you for it. Like what? Who works for free? Like it almost doesn't even make sense. So I don't know. In my opinion, I thought when I first saw that, like I thought that was great, a great opportunity. Anybody who does not have any kind of investments, great. Take advantage of that. Why would you pay a management fee when you could get the same product for 0%? That's great. But I just wonder, like I was like wondering, like, what is this a marketing, like is this for marketing? Are they just trying to get a lot of new customers? I wasn't sure, like, well, what's in it for them? Like, how are you going to sustain that? Like you're doing work for free. I don't understand how that makes sense. At Vanguard, the fees are very, very low, like 0.04%, but they have such huge accounts. They have trillions of dollars invested with them. So taking 0.04% of trillions of dollars, they're making good money. So it makes sense when the fee, even if it's a very small fee, but when it's like no fee at all, like I don't know. I guess I was just confused. Like how the heck they're going to make money? Mm-mm. In the current market, do you recommend REITs? Real estate investment trusts are, thanks for that question, Jacob. Those are investment accounts that allow you, or those are funds that allow you to invest specifically in real estate and like big projects like, buildings or houses, specifically real estate. And I know a lot of people are very big fans of REITs. Me personally, I look at the expense ratios, and that alone is like, it makes me personally not super excited up, because they have very high expense ratios, like over 1%. And when you compound that over the 10, 20, 30 years that you are investing, it eats away at a lot of the returns that you want to make. And, unless they're generating a lot of returns and then they take 1%, it doesn't hurt. But I personally, I think those expense ratios are a little high. I would need more justification to pay that high of a fee. I already maxed out my Roth. Okay, go ahead, Jane P. You better do it. $6,000 already in your Roth, and it's only February 1st. Go ahead, girl. Go ahead. There's so many questions in here, y'all. I cannot keep up. All right, let me see if I can take one more. Otherwise, I'm gonna just be here all day. Milton, I own my own business, and I want to know what type of investments should I make to generate extra revenue. Oh man, with the business, obviously you want to have a lot of cash runway. So you want to focus on that first. I know it's important to invest, of course, and to generate growth on your money and everything, but it's for business owners, especially at a time like right now in a pandemic, you got to have a lot of runway. Runway means that you have just, emergency fund. You have a lot of cash just sitting there. If anything happens with the business, you're going to be able to cash flow money into the business and keep it afloat if anything goes wrong. I think if there's a lot of business owners that I've read about, they were able to keep their business just operating as normal, even without customers during the pandemic. That's huge. That means they had a lot of runway. They had a lot of emergency savings. And that's a beautiful thing. If you can save your own business and keep your own business afloat until things go back to normal, like that's amazing. So that's the first thing in terms of businesses. And then types of investments, I think you have to think about the risk that you're willing to take for your business. And I know personally, like a lot of business owners that like to put their money in bonds instead of stocks because they're not comfortable with the volatility of the stock market. They're more comfortable with the security of bonds. But you have to understand that when you invest in bonds, you're pretty much just barely keeping up with inflation. Your money is just barely doing a little better than the inflation rate. So it's kind of like putting it in a high yield savings account, right? So yeah, I think it's important for you to consider, are you willing to take a little bit more risk and go into stock investments? Or are you like, yeah, no, I really don't want to risk losing this money. I want to be able to funnel it back into my business. So I'm going to stick with bonds or with, accounts that allow you to get a higher return. So high yield savings accounts. All right, y'all. I'm going to peace out. It's 10:30. This was really great. Obviously, y'all are interested in GameStop, so maybe I'll come back and talk more about it as this develops and we find out what's going to happen to Robinhood. Are they actually going to IPO? How does the class action lawsuit play out? What's going to happen to GameStop stock price like after February 1st? So we'll see. We might come back and talk more about it, but I had fun. I answered a lot of questions. If I didn't get to your question, you can always hit me up, missbehelpful@gmail.com, or you can hit me up on Instagram. And if all else fails and you can't reach me, just come back next Monday. I'm going to come back and do another live Monday night next week, and you can ask me questions that I didn't get to answer next week. All right, peace out, everybody. Have a good night. Be safe.